Rolling over your 401k could give you more flexibility, or it could cost you access to key planning strategies. So why do some advisors seem to recommend it more often than not? Today I'll show you when rolling over your 401k to an IRA could be a powerful move, when it could cost you in taxes, flexibility, and long-term opportunity, and when it might just benefit your advisor more than you. I'm Abrin Berkemeyer, Senior Wealth Manager at Willis Johnson Associates. We specialize in helping energy professionals at companies like Shell, Chevron, and BP make smart, tax-efficient decisions about their wealth, especially during career transitions or leading up to retirement. Let's start with the basics. A 401k rollover is when you move money from your employer-sponsored plan into an IRA, or individual retirement account. Whether you're changing jobs or getting close to retirement, this rollover is a common recommendation. But let's get something out in the open. 401k plans are not always directly billable for advisors, but instead, it can create a conflict of interest when moving money to an IRA that is directly billable. Some advisors, especially those tied to broker-dealers, can't manage 401ks directly. That means their ability to charge fees or even work with you at all may depend on whether you roll over the funds to an IRA. And unfortunately, this creates an incentive to recommend rollovers even when other strategies might better suit your financial plan and your timeline. We're fiduciaries. This means we're legally obligated to give advice in your best interest, even if that means leaving your 401k right where it is. Here are 3 big reasons you might want to leave your 401k plan alone. First, early retirement and the rule of 55. If you leave your job at age 55 or later, the IRS allows you to withdraw from that 401k account without penalty. You lose that benefit if you move the funds to an IRA, where withdrawals before age 59 and a half may still face a 10% penalty. Second, brokerage windows within the plan. Some plans allow for a brokerage link, which opens up investment options without losing your 401k protections. This gives you more options and more control within the same 401k that you've come to know. Third, clean slate for backdoor Roths. Let's say you want to convert after-tax dollars to a Roth. If you roll over a 401k and mix pre-tax assets with after-tax assets in your IRA, you'll trigger the pro rata rule and create an unnecessary tax bill. Keeping your pre-tax dollars in a 401k preserves flexibility. You might not plan to retire at age 55, but a few things could pull that date forward. Reorganizations, severance, burnout. The flexibility to access your 401k penalty-free could be game-changing. When your income is high, tax planning around the timing of your retirement is essential. We've worked with clients who've moved their 401k at the wrong time for them and regretted it when learning the true costs of doing so. Now, there are times when making a rollover does make sense. One is net unrealized appreciation, or NUA. When you roll over your 401k, you might be able to roll your company's stock into a taxable brokerage account, while the rest of your account rolls into an IRA. The cost basis of the company's stock is taxed as income at the distribution, but the appreciation in stock price is taxed at preferential long-term capital gains when sold, granted that it was owned for more than a year. Since the appreciation won't be taxed as income like a normal distribution from a 401k, the NUA can provide substantial tax savings when timed and executed properly. Another time it might make sense to roll over to an IRA is for qualified charitable distributions, or QCDs. If you're over age 70 and a half and are charitably inclined, you might make tax-free charitable gifts directly from an IRA to a qualifying charity through what's known as a QCD. Under the annual limit, these gifts do not count as taxable income. The key takeaway? The strategy should lead the rollover, not the other way around. Many professionals don't realize they gave up benefits like the Rule of 55 or NUA eligibility until it's too late. And that's often because the advisor was focused on gathering assets and not building a long-term strategy. We've seen it too often. Advisors giving generic rollover advice without understanding the client's full situation, needs, and goals. If you've worked at your company for a decade or more, your financial picture is too complex for generic advice. So, should you roll over your 401k? It depends. But don't base your decision on what's easiest or best for your advisor. Base it on your goals, your taxes, and your long-term strategy. If you're looking for an advisor who can help you make the most of your retirement accounts with your interests front and center, we'd love to connect. At Willis Johnson Associates, we don't advocate rollovers just to gather assets. We help you evaluate the whole picture, your tax situation, your goals, and your future flexibility. If you're facing a job change or wondering what to do with an old 401k, we'd love to talk. Subscribe for more real-world financial insights or reach out to start a conversation today.